Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, November 15th, 2025. Hey, how you doing? Hey, I hope you had a good trading week. I hope you're having a nice weekend, and I appreciate you coming to my weekend review podcast. I hope you are going to find it helpful and valuable. Wow, what a week we had last week. Some real volatility came into the market. So I hope you're being safe out there. I hope you're following your plan, following your stocks. But yeah, that was some week. That was some week. And so during the podcast today, the format is as follows. First of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week. We're going to take a look at all the new trades I entered. We're going to take a look at some of the trades that I exited, talk about the reasons why I entered, why I exited, and then we'll also talk about how I'm managing the current position. So just to sum up, when did I enter the trade? Why did I enter the trades? What were the setups? What were the confluences and combinations of indicators and signals happening at the time? How I position size based upon the current market volatility, how I place my emergency stop, how I place my end of day stop, how I take partial profits along the way if the market moves in my direction, and then ultimately how I'm going to exit the trade to the upside if it gets to certain levels. So we'll go through all of that. I hope it's going to be helpful for you. If it is, I would appreciate it if you could hit the thumbs up button. Really helps the channel, lets YouTube know that there is some valuable content here. So after we take a look at all the trades, we are going to talk and spend a few minutes on trader psychology. Always the most important skill in trading is the ability to create a plan and to follow the plan. The plan itself, there's a lot of good plans. There's a lot of good trading approaches as long as they incorporate good trading principles like good risk to reward ratios, right? Cutting your losses quickly when you're wrong, letting your profits run if you're right. There's a lot of them. Whether you learn it from me or someone else, there's a lot of them. But if you don't follow the plan, it means nothing, right? You have to have a plan and then you have to follow the plan. That's the most important. So we'll talk a little bit about that in the trader psychology section. After that, I have gone down through my master watch list. I do it every Friday night, and I have identified some potential setups for next week. Now, these setups are not where they need to be yet. If they had already triggered, I very likely would have already taken the trade, but they're getting close, right? They're in striking distance of a potential of taking a new potential entry. And when I go through the watch list and when I'm identifying these for the podcast and for my own trades, I am looking for combinations, confluences of signals that are getting close. And a combination would be, for instance, an order block with the V1, or a order block with a double bottom bullish MACD divergence, or an order block double MACD divergence and a major moving average, or potentially a low under 30 over 30 RSI. So I trade different strategies, but I really kind of combine them and I look for combinations of signals. And the more combinations and confluences that you have happening, the better your chance that you're going to have a profitable trade. It doesn't guarantee it by any means, but it improves your chances. And as traders, we want to stack the odds in our favor at all time. So that's what I'll be showing you. These are the setups that I'll be looking for next week to see if they do what I want to do, what I want them to do in order for me to be able to take the trade. So anyway, hope that is going to be helpful for you. Let's run this U.S. legal disclaimer, get this out of the way, and then we'll get rolling. So hang tight. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, well, let's get started. We'll go through the current trades that I am in, and we'll talk about why I got in. So first on deck is XLE, Energy Sector Select, so Energy ETF. So you see the green box here. This is called an order block. Well, I entered here on the 4th of November. Now, why did I enter? This is a combination. Remember, I was talking about combinations of entries. This is a combination of a rejection of the top of the green box, or a rejection of the top of the order block, and a rejection of the 200-day moving average. This is the combination, right? So this is a great trade setup. It's done very, very well. Excuse me. But let's talk about first, how did I identify why is this an order block? Well, an order block, you need this pattern for an order block to form. You need a swing low. A swing low is a low that has a higher low to the left and a higher low to the right. So if you see these three bars, there's a higher low to the left and there's a higher low to the right, right? So it starts out with the swing low, followed by a swing high. A swing high is a lower high to the left and a lower high to the right. Okay, so we have a swing low, followed by a swing high. Then we need another swing low. These three bars are swing lows. This has a lower high to the left, lower high to the right. So you start off with a swing low, followed by a swing high, followed by another swing low that is lower than the first swing low. And we have that swing low, swing high, lower swing low. Now, in the future, if you take out that first swing high, or in other words, if you go above that first swing high, that's right here, that happened here. Swing low, swing high, lower swing low, we took out the swing high here. As soon as you take out this swing high, now you have changed market structure from a bearish market structure to a bullish market structure. And as soon as that happens, now you can identify the order block. The order block is the lowest closing bar before market structure change. We change market structure here, so we go to the left. Where's my lowest closing bar? Ah, here it is. It's the high and the low moved into the future. And in the future, if it ever comes back to revisit that order block, that is when I look to take an entry. Okay, so swing low, swing high, lower swing low, market structure change. Now, a deep dip buy signal incorporates using the 200-day moving average, which is the black line, or the 250-day moving average, which this doesn't show in here at the moment, and a 300-day moving average. Doesn't matter. 200-day moving average, 250-day moving average, 300-day moving average. These are all major moving averages. And a rejection of one of these moving averages is a valid signal by itself. So you can see on the day that I entered here at 11:04, we went below the 200-day moving average, and then we closed above the 200-day moving average. That by itself is a legitimate signal. But you can see the confluence of this particular trade is on this day, we went into the top of the order. From above, we went below the top of the order block and then closed back above the top of the order block. That by itself is a legitimate entry. But look what we did. We also rejected the 200-day moving average. We went below it and closed above. So two completely valid signals, a rejection of the top of the order block and a rejection of the 200-day. That's why I took the trade 87.18. Okay, now, as soon as I take the trade, the first thing I have to decide is how many shares am I going to buy, right? This is extremely important. I think it's the most important part of trading is how many shares you buy. I mean, it comes down to that. So I use a simple formula, and it's based upon how much money I have in my trading account. And it works for any amount, but let's just say I have $100,000 in my trading account. Okay, I simply take 1% of my $100,000, which is $1,000. If I had 200,000, it would be 200. If it was a million, it'd be 10,000. If it was 50, it'd be 500. right? But in this particular case, 100,000, 1% of that is 1,000. Now I find the average true range, the 2ATR. This is 2 times the average true range. This is what helps you in this formula position size based upon volatility, because if there's a lot of volatility, this 2ATR is going to be a larger number, and when you divide it into your $1,000, it's going to give you a lot fewer shares. If it's smaller, it's going to have you buy more shares. So in other words, just dividing that $1,000 or the 2,000 or whatever it is, dividing that 2ATR, that's how you adjust for volatility. Because if this number is very high, it's going to have me buy fewer shares. Okay, so 1% of my total capital divided by whatever the value of the 2ATR is on the day that I buy it, 1,000 divided by 287. Magic presto, it tells me to buy 348 shares. Okay, for the account size and for the current market volatility, the way that I trade, that is the correct amount of shares to buy. Okay, so I have the rejection of the high of the order block. I have the rejection of the 200-day moving average. I just did the math. It tells me to buy 348 shares. What's the next thing I do? The next thing I do is I take my entry price minus the 2ATR, the value of the 2ATR, and I place a red line below. That is called my emergency stop. Now, think about it. If I have 348 shares and it moves down 287 to my emergency stop, I've lost $1,000, right? I've lost 1% of my account. That's the maximum I want to lose on any one particular trade. That's it. There's a certain point where you have to just say, I'm willing to lose this, but if I lose that, I have to get out immediately. And so that is why I have the emergency stop down here. It's not fun to lose 1% in your account, but you can certainly come back from that. It's not game over, right? Like, you can come back from it. So that's how I place my emergency stop. The entry price minus the value of the 2ATR, that's my emergency stop. And if it got down there, I would lose 1%. Now, the good good news is that this emergency stop only happens about 5% of the time. 95% of the time, if you have a loss, it will not be because you hit your emergency stop. It will be because of your end of day stop or your end of bar stop. Well, my end of bar stop is simply a close below this black line. You see how close it is? You see how close my entry is to this line? The next day, if it had closed just even a penny below that 200-day moving average, that's my signal to get out. So I have two stops. Emergency stop, that's 2ATRs away. And if that hits, I lose 1% of my account. But 95% of the time, if I have a loss, it will not be the emergency stop. It will be a close below my end of bar stop, which could be just a very, very small loss, right? Certainly not going to be 1%. It could be a tenth of a percent or something like that. But this is the main thing in trading, is trying to have a good risk to reward ratio, so that if you're wrong, you could be very small. And if the next day this had closed below the 200-day moving average, I could have been had a very, very small loss. But luckily it went my way. Okay, now, so we have the entry, rejection of the high of the order block, rejection of the 200-day moving average. I have position size based upon the volatility, as I just showed you. I placed my emergency stop 2ATRs below. My end of bar stop, simply a close below the 200-day moving average. After I enter and I know where my stops are, the next thing I do is I take my entry price and then I look for the value of the 1.5 ATR. The value of the 1.5 ATR is 215. So I take my entry price and I add 215 above. That's the orange line. That is my trailing stop level. If, when I get into the trade, if it gets to my trailing stop level, the 1.5 ATRs above, now I go into trailing stop mode. It doesn't mean that I do anything. It just means now I'm in trailing stop mode. So now in the future, if I have a close below a previous bar's low, I will exit half the position. In trading, as the market moves your way, you need to start tightening up your stops. And for me, if it moves 1.5 ATRs above my entry, now is the time for me to go into trailing stop mode so that if I get a close below a previous bar's low, I'm going to exit half. And by exiting half, you're tightening everything up, right? You're getting rid of everything. So you're tightening everything up twice. And that's proper trading. You go into trailing stop mode and tighten everything up. And by selling half, that brings everything up by half. Okay? Now, everything I've talked about so far, which is the end of day stop, end of bar stop, the emergency stop, going into trailing stop mode, these are all defensive moves. In other words, if the market goes against me, I need to take action. And that's fine. You have to do that. But I also like to play offense in my trading as well. Just like a sports team, you have to play offense and you have to play defense. Your end of bar stop, your emergency stop, you're going into trailing stop mode. These are defensive moves. But playing offense is I sell a portion of my position into strength. Not all of it, but a portion every day if it moves a certain amount from the previous bar's close. So let me show you how to do this. So I'm in XLE right now. Let me just show you what I'm going to set up for Monday. I take the closing price of the day. Very clear, it's 92.02. And now I look for the value of the the value of the 0.45 ATR. The 0.45 ATR value is 65 cents. I simply take the closing price plus 65 cents, and this moves every day. 65, it won't be 65 Monday, but today, going into money, it is. So closing price 92.02 plus 65 cents. My first profit target for Monday is 92.67. And if it gets there, I will sell 10% of however many shares I went into the day. If I go into the day with 100 shares, 10% of that is 10. I would sell 10 shares at 92.67. If I went into the day with 500 shares, I would sell 50 shares at 92.67. Okay, but I place 3 profit targets, not just one. I place the first one, which again is the closing price plus the value of the 0.45 ATR, 92.02 plus 65 cents is 92.67. That's my first one. Now, I take my first profit target, 92.67. I add the 65 cents to that. My second profit target is 93.32. And again, I would sell another 10% of however many shares I went into the day at the second profit target. And then I do it one more time. I take the second profit target, 93.32 plus 0.65. My third profit target for the day, 93.97. So I always place 3 profit targets during the day. If it's up decently, I may hit 1, take a little off. If it's up really nice, I could hit 2. If it's up great, I could hit 3, right? And then if the market's down on the day, I don't hit any. But the key is selling a portion into strength. Okay? Okay, so I hope that makes sense. All right, so now that I've kind of gone over the basics here, let's just kind of start over. Why did I take the trade? We rejected the high of the order block. We rejected the 200-day moving average. I position sized. I placed my emergency stop 2 ATRs below. My end of bar stop is a close below the 200-day moving average, or the black line. I place my trailing stop level 1.5 ATRs above, and off we go. Here we go. The next day, what did it do? Went up, hit a profit target. Great. Did it close above the 200? Yes. I stay in the trade. Next day, up again. I hit another profit target, scaling out into that strength. The next day, up again. Perfect. Another profit target, and now it got to trailing stop mode. It doesn't mean I do anything. It just means now I'm in trailing stop mode. So in the future, if I get a close below a previous bar's low, I'm going to sell half. The next bar, up again. Profit target. Perfect. Next bar, up again. Multiple profit targets. I believe I hit 2 profit targets on this day. Next day, down. Did it close below a previous bar's low? Yes, it did. Had it already gotten to trailing stop level? Yes, it had. So what do? I take off half of the remaining shares on that day. And so here I locked in on half of the position, a gain of 3.25% on the trade. Next day up, another profit target, and then up Friday again, multiple profit targets. So I'm selling into this strength. Now, at the high of the day, we were to 65 RSI. Right now it's 64.79, but we were high in the day. If I get to a 65 RSI, now the 5 EMA comes into play. This is this thin blue line here. So now this trade is very, very easy for me. If in the future, if I close below the 5 EMA, I'm simply out of the trade. Or if we get up to the 70 RSI and reject the 70 RSI, then I'm going to take another half off. And if this happens, I'll show you. But these are all rules that I use and have learned from over 30 years of trading to follow. Because once you start getting up near the 70 RSI, the majority of the time, that's about it. That's an overbought level. But when you have a nice trade like this that takes off like this, and you get to the 65 RSI, now that 5 EMA comes into play. So I love being in a position in this kind of trade where if it just simply closes below the 5 EMA, I'm out. Okay. So that, and again, that's having a trailing stop and keep increasing your stop as it's moved in the direction that you wanted to, and that 5 EMA is very close. So the remaining shares that I have on XLE doing quite well, up 5.22%. USO. All right. USO, I entered back here on the 20th of October. Here we have an order block from the past. I'll take you back real quick. This was a long time ago, this order block. But again, order block, why is this the order block? Because we had a swing low, and then we had a swing high, and then we had a swing low, and then we went up and took out that swing high. So when that happens, that happened on this bar, the high and the low, the lowest closing bar before market structure change is your order block. The high and the low of that bar brought into the future. Now, let's take a look at this. After we changed market structure here and it went skyrocketing, is it fair to say, in hindsight, when it's up here, that smart money was buying down here? And I would say 100%. If it's up here, smart money was buying here. So this order block is a smart money area. So when I bring that order block into the future, if after this big move up, if it comes back down to that smart money area, well, does it mean it's smart money area again? Not necessarily, but more times than not, it is. If smart money was buying here and then it ran, and now it comes back to that area again, I'm going to assume from the way that I trade, that is still a valid place to potentially put on a trade because smart money was buying there before. Okay. And you'll see very, very often after you change structure and then you come back to the order block, it goes up again. So here's the high and the low of the order block. I move that all the way into the future. And if and when it comes into the order block, do you see? There we go. It rejected the high of the order block, meaning it went into the order block and then closed above the order block. From an RSI perspective, I believe we bounced at the 30 RSI. That's a deep dip buy. So that's the confluence of signals. We bounced at the 30 RSI and we rejected the high of the order block. So I entered here at 67.81. Position size. Place my emergency stop 2 ATRs below as always. My end of bar stop is simply a close below the low of the order block. You see how this stop is closer than the emergency stop? And so this low is 66.03. So when I took the trade at 67.81, if it closes below 66.03, the low of the order block, I'm going to get out. Or of course, if it goes to my emergency stop, I'm going to get out. So I took the trade here, 67.81. I placed my trailing stop level 1.5 ATRs above, and off we go. The next day, took right off, profit targets. Great. Next day, big day up, multiple profit targets, and I got to trailing stop level. Next day, huge up, multiple profit targets. Okay. Next day didn't do much. Next day didn't do much. Next day we go down and we close below a previous bar's low after getting to trailing stop level. What did I do? I took off half of the position for a gain of 4.97%. And then next day we moved up a profit target. Next day, really nothing. Next day we moved up a profit target. Then we kind of moved down here, no profit targets. Then we kind of moved our way up here. We had this gap up, selling into more strength. Then we had a big down bar. And then the next day up a little bit. And then Friday up nicely again where I hit 2 profit targets. So the remaining shares that I have on this position doing quite well, up 4.99%. MO, which is Altria Group. All right, well, we have an order block from the past. I took the trade here on the 3rd of November. Why? This is a rejection of the bottom of the order block. A rejection of the high of the order block is legitimate. A rejection of the low of the order block is legitimate. But on this day, we went below, but closed back in. That is a rejection below the order block. I entered 56.63. I placed my emergency stop 2 ATRs below. My end to bar stop on this trade is simply a close below the low of this order block. Look how close the price is to the low anyway. So if the next day would gone down, closed below the order block, okay, probably not that big of a loss. I mean, could be if it really went down, but literally if it closed a penny below the order block, I'm out for a very small loss. Okay, so rejection of the bottom of the order block position size, place the emergency stop 2 ATRs below. My end of bar stops a close below the low of the order block. I place my 1.5 ATR trailing stop level above as always, and off we go. Next day up, can't remember if I hit a profit target there or not. Next day for sure hit a profit target. Then we kind of moved sideways, kind of nothing, then a little up, and then kind of nothing. Then we had a nice move up here where I did hit a profit target. And in addition to hitting the profit target, look, I got to trailing stop level. So now that I'm in trailing stop mode, if I have a close below a previous bar's low, I'm going to get out of half. Next day did not close below. But Thursday, we closed below the low of a previous bar after reaching trailing stop level. What do? I take off half of the position, and I locked in a gain of 2.2%. And then Friday, we were up again, not enough for a profit target. And so the remaining shares that I have on MO up 2.73%. So not bad. Costco. All right, I entered Costco here at 9/11 on 10/29/25. We have an order block. Now, I like to see 200-day moving averages or 300-day moving averages or 250-day moving averages or under 30 over 30s. See, this is combining deep dip buy with order blocks. But in this particular trade, there were no moving averages living inside this order block. But I make my own levels inside order blocks. And that happened over here on the 7th of October. You see the big up bar we have here? Whenever you have a big up bar, from a Fibonacci standpoint, the halfway of that big up bar, more times than not, will offer some type of support. So if you go up here and you come back to about halfway, that's generally where you're going to find some support. And you can see just here, we went up. The next day did kind of come down. It didn't quite get to the halfway line, but then it took off. So When I'm taking trades over here in an order block, I look to the left to see if I have something like that. And I do. Here's this up bar. Here's the halfway. I bring it into the future. Well, we came down, and then look what happened here on the day that I took the trade. One, we got into the order block. And two, look at that. We rejected the halfway point of this up bar. So I took the trade. I position sized. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below this halfway, giving me a good risk to reward ratio. Next day, moves up. Great. Took a profit target. Next day, down, but held above my stop of 908. Next day, look, we tested that halfway point again and then rocketed up. I hit multiple profit targets. Next day, up again. Multiple profit targets. Next day reversed. And then here on this day, on the 6th, we have our first close below a previous bar's low after reaching trailing stop level. What do? I have to take off half of the position, and I locked in a gain of 1.36%. But the interesting part about this, look, we tested that level again. The next day, up again. Luckily, I sold some a portion into that initial strength, right? And then we came down again. Where did we stop? We stopped exactly at the level that I indicated that I thought it would stop at. Like almost to the penny. Went down a few pennies. Next day, up again. Profit target, then down. Kind of nothing burger. Thursday, we moved up. Profit target. And then Friday down a little bit, no profit target. So the remaining shares, excuse me, yeah, the remaining position that I have, the remaining shares I have left, up 1.31%, which, is fine. It's great. But I think from a teaching perspective, it shows that when you have these up bars, big up bars, look, we tested that halfway point 1, 2, 3, 4, 5 times, and it held. So again, the halfway point inside the bullish order block, and the remaining shares up 1.31%. Okay, let's go to NVDA. All right. Well, NVDA formed an order block, and let's talk about why. We have a swing low, followed by a swing high, followed by a lower swing low. Then we took out the swing high here. It defines the order block. After you take out the swing high, lowest closing bar prior to market structure change, move that into the future. Okay, we have our order block. And again, when you're up here at all-time highs and you look back in hindsight, was smart money buying this? Yeah, they were. So if we get back to this smart money area again, will smart money buy again? Maybe. More times than not, it happens, but not always. So I got into NVIDIA here on the 7th of November at 188.20. Why? Well, two reasons. One, we rejected the high of the order block. In other words, we came into the order block and then closed above the top of the order block. That's a rejection of the high of the order block. In addition, I told you before that I like to look for moving averages inside the order block. Usually it's a 200, 250, 300, but really any moving average will do. But here's the gray line. The gray line is the 50-day moving average. So there is my signal. Two signals. One, a rejection of the high of the order block. Two, a rejection of the 50-day moving average. Meaning we went below it, closed above it. So I entered 188.20 position size. Place my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 50. Close. Keyword, close below the 50. Place my 1.5 ATR trailing stop level above. Next day, boom. Off to the races. I think I hit 4 profit targets on this day. I always place 3, but I don't place 4 because it doesn't happen very often, but I can add one on. And I think that's what happened. It was 3 or 4. Next day, huge move up. And in one day, got to trailing stop level. So So scaled out a lot on the way up, got to trailing stop level. The next day, we have our first close below a previous bar's low after reaching trailing stop level. What do? I took off half the position for a gain of 2.64%. The next day, up a little. I think there was one profit target there. Thursday, down big, no profit targets. Friday, of course, we opened way low and reversed, but we closed above the 50. Friday had this close below the 50 out of the trade, right? So the remaining shares that I have on NVIDIA up 1.01%. But can you see here, I mean, especially on this example, why it was so important for me to take partial profits when the market gave them to me? If I would have just held on to this trade, yeah, I would still be up on the trade a little, but I'm up a lot more because of taking the profits when I had them. And the trailing stop level on this trade helped as well. So the remaining shares on NVIDIA up 1.01%. Of course, if we close below the 50, I'm out of the trade. And then we have earnings on the 19th of this month. I never hold through earnings. So regardless of where this trade is, if I'm still in it, whether it's up a little, down a little, up huge, whatever. But if I'm still in the trade based upon all my levels, I will exit before earnings. I never hold through earnings. VIXY, VXX. You know, the VIX over the last couple months has been a great indicator of what the market's doing. So here you see the green box. The green box is an order block. Why is it an order block? Well, let's start over here. Here's a swing low. Here's a swing high. Here's a lower swing low. Here's a market structure change. As soon as we have a market structure change, we can define the order block. Here's the order block, the high and the low of this bar on the 9/18. We bring it into the future. Now, I took this trade, if you remember, because we changed market structure, we came back down into the order block. That's the buyable area. I bought there, had that huge trade on VIX. Then we came all the way down to the order block, closed below it, closed back in it. That was another legitimate entry, and it took off. I took the trade on the VIX here on 11/11 because, no, excuse me. Yeah, it was here. Because we rejected the bottom of the order block and we had a V1. Now, I use V1s, V2s for a lot of my entries to help increase the chances of a good start to the trade. If you want to learn more about V1s, V2s, go to my YouTube channel, look for the V1, V2 lesson. But in this case, this is a V1. What's a V1? A V1 consists of two bars, bar 1, bar 2. Bar 2 has to go bar 2 has to go below the low of bar 1 and then close above the close of bar 1. That's what we did. Bar 2 went below bar 1's low, closed above bar 1's close. That is a V1. In addition to the V1, we rejected the bottom of the order block, right? We went below it, closed back in it. That's a rejection of the bottom of the order block plus a V1. I entered 32.89. I placed my emergency stop 2 ATRs below. I placed my 1.5 ATR trailing stop level, 1.5 ATRs above. And again, my end of bar stop is simply a close below the low of this order block. You see, if we close below the low of the order block, I simply get out. It's not that far away, so it's a good risk to reward ratio. Okay, so I have everything set up. Next day, up huge, right? Up huge. I took off 4 profit targets, I believe, on that day alone. And got your trailing stop level as well. Friday, 2 profit targets in the morning as VIX rallied hard. And then it reversed hard as the market went up. But do you see the value in taking these partial profits when I have them? I mean, VIX could be down here by next week, but I had already locked in the profits on the way up and then here too. So I'm at trailing stop level, or I'm in trailing stop mode, but I have not yet closed below the low of the order block. The remaining shares that I have on this trade up 4.89%, but clearly I locked in things higher using the intraday profit targets, right? Now, the other thing I wanted to mention is that from a market perspective, when VIX changed market structure to the upside and then came down into the order block, if you remember, I was telling you, be careful about market tops when you're in this order block. And as it came back into the order block, that was the top of the market. And then as VIX rallied huge, of course, the market went down. As the market rallied back up, VIX went down. As we came back into the order block, what did the market do? Market went down again. Here we went back up. Now we came back into the order block. What am I expecting the market to do? Go down. And that's exactly what happened. So it's interesting to watch VIX. VIX gives you a good idea when you come into these major VIX areas of market tops, and it's exactly what happened. So it was a really nice trade. Remaining shares on VIX up 4.89%. All right, RBLX. This is a trade that I entered on Friday. I'd like to thank one of my students, Vivek from Canada, pointed this out. I believe Vivek took the trade on Thursday, which was legit. Why did he take it on Thursday? It was a rejection of the low of the order block. See how we went below the low and then we closed back in? That's legit. Now, I took it on Friday. Why did I take it on Friday? Same reason. We rejected the bottom of the order block. We went below it and then closed back in it. So there's one signal. But we also had a V1. Remember, I was just telling you about V1s. Bar 1, bar 2. Bar 2 goes below the low of bar 1's low, closes above the close of bar 1. Okay, perfect. That's the combination. Rejection of the bottom of the order block plus a V1. I entered at 102.11. Now, in addition to that, you often hear me talk about megaphone trend lines. A megaphone trend line is just when you have a swing low, you find another swing low, you connect those together. See how I connected this one to this one? Brought it out into the future. Now, if in the future the market comes down to meet that extended megaphone trend line, right? Swing low, connect those here. If and when the market ever gets down to making that third touch of the trend line, you'll generally get a reaction there and you'll generally bounce. Well, that's kind of exactly what happened, right? We got here almost there. I mean, nothing here, but once we got to that projected megaphone area, that's where it did bounce. And then it bounced, but it came back again. But look, on Friday, we touched the bottom, or we touched that trend line exactly, almost to the penny, right? Pretty eerie that we touched that to the penny, and that's where the buyers came in. So it's a rejection of the megaphone trend line. It's a rejection of the bottom of the order block, plus a V1. I entered 102.11, placed my emergency stop 2 ATRs below, placed my trailing stop level how far above? That's right, 1.5 ATRs above. So it's a brand new trade. If it moves up on Monday, I'll take partial profits. If it gets a trailing stop level, I'll go into trailing stop mode. If it closes below the low of my order block, I'm simply out of the trade. So I know exactly what I'm going to do with this trade, regardless of what the market does. If it goes up, I know what to do. If it goes down, I know what to do. If it doesn't do anything, I know what to do, right? If-then statements. If it does this, then I'm going to do that. If it does that, then I'm going to do this. That is what a trading process is. Now, you can have all these rules, but if you don't follow them, they're worthless, right? That's why it's important. You know, my big thing in teaching people, get yourself a plan, but more importantly, follow that damn plan. That's the important thing, all right? So this trade, basically break even. I just bought it at the end of the day on Friday. So we'll see what happens with that next week. Okay, so a review on the open positions, remaining shares on XLE up 5.22%. Remaining shares on USO up 4.99%. Remaining shares on Altria Group MO up 2.73%. Costco remaining shares up 1.31%. NVDA remaining shares up 1.01%. VIX remaining shares up 4.89%, and RBLX but basically even because I just entered it. So you can see nice trades on all of those. Really grateful for that. I had a really good week because these positions all did really well. Okay, let's go to the closed positions. I did have a losing trade that I had to close out on Home Depot on Friday. Okay, so I entered Home Depot HD at 370.42 back here on the 10th of November. Why? Well, you see the order block. And then on this particular day, during the day, we went below the 30 RSI and then close back above it. You hear me talk about deep dip buys, right? Usually with the 200, 250, 300. Well, another deep dip buy signal is the 30 RSI. If you go below the 30 RSI and then close above the 30 RSI, that is a legitimate signal. And that's what happened here on Home Depot. It went below the 30, closed above the 30. So I entered 370.42. I placed my emergency stop 2 ATRs below. I placed my trailing stop 1.5 ATRs above, and off we go. The next day, boom, started off great, right? Did very well. The key thing here is that I did hit a profit target. I at least took a profit target off before it reversed, right? And that's what's also great about taking partial profits. If you take a partial profit and then it reverses on you, well, at least you sold something so it mitigates some of that loss. Make sense? So my end of bar stop on this trade, when I took it, was a close below the low of the order block. What did it do on Friday? It closed below the low of the order block. Now, here's my emergency stop down here. Again, only 5% of the time. Yes, this was a loss. 95% of the time, if you have a loss, it's going to be a close below your end of bar stop. My close below the end of bar stop was simply the low of the order block. So this was a losing trade, and I did lose 2.24% on this particular trade. You can't win them all, right? It's fine. It's absolutely fine. You're going to have thousands and thousands of losers. But if you're trading right, you're trading a good approach, these losses should be pretty small compared to some of your winners. So I did exit Home Depot because it closed below the low of the order block, took a loss of 2.24%. Disney. I also exited Disney, but let's first talk about why I took the trade. Okay, there was an order block from the past. I took the trade here on the 16th of October. Why? Rejection of the high of the order block, rejection of the 200-day moving average. So this was an order block deep dip buy combination. I entered at 109.69, 109.86. Why again? Rejection. There was a 200-day moving average black line inside of the order block. It went below the 200, closed above. Entry 109.86. I placed my emergency stop how far below? 2 ATRs. Where's my end of bar stop? A close below the low of the 200. See how close I am to the start of the trade anyway? I placed my 1.5 ATR trailing stop level above, and off we go. Next day, goes up. I hit a profit target. Next day, goes up. Hit a profit target. Next day, up biggies. Hit multiple profit targets, and I also got to trailing stop level. Next day didn't do much. Next day didn't do much. And then here on the 24th was our first close below a previous bar's low. After reaching trailing stop level, what do? I take off half of the remaining shares that I have for a gain of 1.67%. The next 3 days, we go down. Remember, my end of our stops are closed below the 200. The next day, during the day, we got below it, but reversed up nicely, hit multiple profit targets into that strength. Next day, kind of a nothing burger. Then we kind of consolidated. We went down here on the 6th. What did we do? We again tested below the 200, but closed above. That kept me in the trade. Then we started to move up. Moved up, profit target. Moved up, profit target. Moved up, multiple profit targets. Move next day up again, multiple profit targets, and I exited here at 116.94 and I got out. Why did I get out? because earnings were the next day and I do not hold through earnings. Holding through earnings is the quickest and fastest way to lose a lot of money quickly. Yes, you can make a lot of money quickly too, but that's the problem in trading, that most people have the wrong mindset. You need to look out for the downside more than the upside. If you concentrate on limiting your losses and not putting yourself in a position where you can lose a lot of money, ironically, that's how you make money. If you only concentrate on the gains, that is how you lose money. And if you try to hold through earnings to time earnings and guess at earnings, gamble on earnings, yeah, sure, you can make a lot of money quickly, but you can lose a lot of money quickly. And am I glad I got out before earnings at 116.64? Yeah, obvious, right? Because look what happened on earnings. The people that gambled on earnings, if they still own the stock, are down over 10%. So the remaining shares that I had, I did exit Disney right before earnings for a gain of 5.78%. Pretty good. So recap on the closed out trades. On Home Depot, a loss of 2.24%, and on Disney, a gain of 5.78%. Okay, so those are the open and daily trades that I currently have. I also trade the weekly bars as well. Weekly bars, every bar is a week. On a weekly bar trade, exact same setups. It's just that you make your entries and exits on Fridays at the end of the bar. So every bar here is a weekly bar. This is XLV. I entered XLV here on the 8th of August. Why? Well, as with many of my trades, rejection of the high of the order block, rejection of the 300-day moving average. Combination, the 300-day moving average is deep dip buy. The rejection of the high of the order block is order block trade, right? So if you've been watching this podcast, I talked about taking this trade for many weeks. I said, look, I want to see it come down into the order block. I want to see it reject the 300 week moving average. That happened here on the 8th of August. We not only did we bounce at the 300 week moving average, we also rejected the high of the order block. I got in at 130.07. Placed my emergency stop 2 ATRs below, as always. My end of bar stop is simply a close below the 300 week moving average, the orange line. I placed my 1.5 ATR trailing stop level above. Next day, or next week, excuse me, rallies big. What do? Take partial profits, right? I think I hit two profit targets that very next week. Up. Next week, up again, one profit target, and now I'm in trailing stop mode. Doesn't mean I do anything. It just means now in the future, if I have a close below previous bar's low, I get out of half. We move sideways here on this trade for about a month. And then here on the 26th of September, we have our first close below a previous bar's low. What do? I take half of the position off for a gain of 3.99%. Next week, up biggies. Multiple profit targets into that bar. Then we move sideways for a couple weeks. This next week we go up, hit a profit target. Didn't do much for the last 2 weeks. But then this week, big up again, multiple profit targets into that move up. We are at 66 RSI, 66.22 RSI. If I ever get to 66 or above, now the 5 EMA comes into play. That's this thin blue little line here, the 5 EMA or the 5 EMA. Going forward, if we close below this 5 EMA, that will be my signal. Take profits, be done with the trade. The remaining shares on XLV doing really nice, everybody, up 14.34%. Okay, but this is a good example of being patient, waiting for a signal. The signal was a bounce at the 300-day moving average and rejection of the high of the order block. My end of bar stop on this was simply a close below the 300. So see how close it was. So I'm very close to my stop anyway. But I don't have limited I kind of have unlimited to the upside. So I'm risking little to make a lot, and that's exactly what happened. Okay, so XLV up 14, remaining shares up 14.31%. Last uh, uh, last position, weekly trade, UUP, which is the US dollar. Okay, I bought the US dollar all the way back here on 7/11. Same old story, everybody. Rejection of the 200 week moving average and the rejection of the order block. Here's the order block in the green. I entered here 27.21 on 7/11. Why? We rejected the high of the order block. Prior bar was in it. We closed above it. There's one. Prior bar, we were below the 200 week moving average, closed above. There's your confluence. There's your multiple signals. Rejection of the 200-day moving average, rejection of the high of the order block. In at 27.21, place my emergency stop 2 ATRs below, place my trailing stop level 1.5 ATRs above. Next week, right off the bat, up profit target. Next week, down, but it held the 200-week moving average, right? The 200-week moving average, the black line, is my end of bar stop. It tested it, but closed above. That kept me in the trade. Next week, up big. Multiple profit targets, got into trailing stop mode. Next week, down. Next week, down again. We had a close below a previous bar's low after reaching trailing stop level. What do? I take off half of the position for a gain of 0.51%. Then we move sideways here for about 4 weeks. And then this bar, this was key. We went under the 200. I thought, oh, I'm going to be out of the trade. But it closed above, kept me in the trade, thankfully. Next week, up. Next week, nothing. Next week, up with a profit target. Next week, nothing. Next week, up big. Multiple profit targets. A couple weeks sideways, another bar up again. Another profit target into that strength. Right now, we are at a 57.89 RSI. If we get to a 65 RSI, then the 5 EMA, or 5 EMA, comes into play. If we get up to the 70 and reject the 70, I'll exit some of that there as well. So going forward, as long as we stay above this 200-day moving average, I am in unless we get up to the 65 and then lose the 5 EMA. So this particular trade, the remaining shares up 3.2%. So you see, it was a really good week. I had all these positions, 1, 2, 3, 4, 4, 5, 6, 7, 8, 9, 10, 11, and profitable 10 of the 11. So not too bad, right? Yeah. So this stuff works, everybody. Yep, it really works. But there's a lot of things that work. You just have to follow the process, which gets into trading psychology. So let's talk, before we take a look at the trades for next week, let's talk about trader psychology, should we? Okay, so this trader psychology post comes from Rainer Teo. Rainer is a great trader, author, educator. He has a really great backstory on his trading. I read all of his posts and kind of his back trading and his journey. But great trader, great author. I would highly recommend that you follow him at Rainer_Teo over on Twitter X. Whenever he has a post, I always read it, take it in. He has great posts, and they're always insightful and educational. So give them a follow. So let's see what Rainer has to say here. No edge, no discipline, no accountability, no risk management, no surprise why most traders fail. 100%. I could not agree more. You know, in my podcast every week, I talk about the importance of creating a plan with good trading principles, good risk to reward ratios, being impatient with your losses, being patient with your winners, having a plan, following the plan, right? And what he is talking about here, there's none of that. And most traders don't have this, which why Rainer says, no surprise why most traders fail. No edge. What's an edge? An edge is a probability on a particular trade that if you put this trade on, it's not going to win every time, but it's going to win more than it's going to lose. I mean, look, you can have systems that only win 40% of the time but are profitable, right? So it's not the winning percentage, it's the profit factor that really matters. You can have systems that win 89% of the time but actually lose money, right? So the, the, the amount of the profit, the winning percentage really doesn't matter. It's overall. But regardless, doing your back testing and so forth, you need to have an edge in what you're doing, right? When I buy in order blocks, I buy off major moving averages, and I have a very good risk to reward ratio. I know from back testing that that is profitable. Not every trade, but over time. So, but there are a lot of setups that have edges. But do you have an edge? Do you know if you have an edge? Is your system, have you back tested things? Do you know that it has an edge? Well, first of all, get yourself an edge, right? Everything that I trade has an edge. But if you're not using an edge, it's like flipping a coin, right? Get yourself an edge. No discipline. Okay, well, you can have the best trading plan in the world. You can have a system that has an edge. But if you don't have discipline and follow it, what good is it? No accountability. This is a very important part here. This, I've traded for over 30 years, and the accountability portion is huge. Look, I know hedge fund traders. I consult with hedge fund traders. I know a lot of professional high-level traders. Look, there is if you're at a hedge fund, people are watching you. There's an accountability there are always people overseeing you in a professional situation like that, right? Just like in a casino, right? The pit boss is watching the dealer, the eye in the sky is watching the pit boss, and all of that. There's always accountability. Someone is watching you. But when you're an individual retail trader, who's watching you? No one. You don't have to be accountable to anyone. And that's where your problem is. The more accountable you are to something or someone, the better you're going to trade. If I was sitting behind you every day on your trades, I promise you, you would trade better. I promise you, because I would be looking over your shoulder. But retail traders don't have that, and that is an issue. Professional traders and hedge funds or large financial institutions, they have someone looking over their shoulder, which guides their behavior. My suggestion is that you involve your spouse, your brother, your friend, share your trades so you have some type of accountability, someone looking over. You're going to follow your plan better, right? There's a lot of things, if people were watching us, we wouldn't do, right? If someone's watching you, you're probably not going to do it. In trading, if someone was watching you, you would trade better. There's no doubt about it. So get yourself some accountability, friend, spouse, friend, partner, whatever. Okay. No risk management. Well, risk management, is incorporated into discipline of your plan. If you have a good trading plan, you have if-then statements. If you're going to do this, then you're going to do that. If that happens, then you're going to do this. Okay, it's all part of your plan, the risk management, and it dovetails with discipline. So no edge, no discipline, no accountability, no risk management, no surprise why most traders fail. Get yourself a thorough plan with if-then statements. You can learn it from me. I teach people all over the world. Happy to have you as a student, teach you everything I know, or learn it from someone else. But regardless of where you learn it, you have to follow it. Get yourself an edge. Get yourself some discipline. Discipline, baby. Get it. Have someone or something to be accountable to. For God's sakes, risk management, hugely important. So thank you, Rainer Tio, for that. Appreciate that. Please follow Rainer. You'll be glad you did. He has great information, and thanks for this great post, Rainer. All right, let's get on to the potential trades for next week. See what's going on there, and let's start off with Amazon. By the way, I have 15 particular setups for next week. Now, I say this every week, everyone, but I have a rule in my trading, part of my trading plan. I only take one trade per day or one trade per time frame, even if I have 15 to choose from, right? Here's 15 different symbols for next week. Theoretically, on any one day, all of these could trigger. Does it mean I take 15? Absolutely not. I'm going to take the best one. How do I decide if they're all legitimate? How do I decide what the best one is? I give all of my setups a quality score. If it has one signal, it gets 1 point. If it has two signals, it gets 2 points. If it has three signals, it gets 3 points. Obviously, if one has 1 point, the other has two, the other has three, I'm going to take the one with three, right? So how many signals, what the confluences are, what the risk to reward ratio is. And see, the risk to reward is a tricky one. You could have a signal that has 5, 6 entry signals, but it has a horrible risk to reward ratio. Well, I'm going to have to skip that one, right? So there's nuances to this. So I give every signal a quality score. I also look at the risk to reward ratio, which is huge. I also look at larger time frames. If I'm trading the daily, I want to look at the weekly. Is there something there on the weekly that's telling me there's some support or signals from the weekly traders on the weeklies? I also look at relative strength. Relative strength means if the market's up but this stock is down, that has negative relative strength. If the market's down but this stock is up, it has positive relative strength. Well, that one gets an extra point. It gets an extra brownie point for being up in a down market. So the devil is in the details in this. And when you're looking at multiple entry signals, me personally, I narrow it down to one. And it's very important to do that. And this is what I teach my students. And look, I teach people all over the world. I teach a 20-hour course. I think really honestly, the best way to learn is over a long period of time consistently, one-on-one with your coach or your mentor. And that's why I've structured my coaching like this. So if you become a student of mine, we have a 2-hour call every week for 10 weeks. I teach you all the different trading approaches that I use. We do all sorts of simulation trading, and we look at different markets. And when you work with me for 10 weeks, you're going to see the market change over 10 weeks. And I think that's a real added benefit. So if you're interested, I would love to have you as a student. In my 20-hour one-on-one course, we do that in evening times via Skype, or not Skype, excuse me, via Teams. I also record the lessons so that you have it. But I've taught people from all over the world, from absolute beginners all the way, like I said, up to professional hedge fund managers and everywhere in between. So if you're interested, send me an email. The email is in the link of my YouTube video. And just send me an email. We can get the process started. You've heard me talk about deep dip buy as well. And of course, I teach that in the 20-hour one-on-one course. But I also have a really good Udemy course. The link's in the description of the YouTube this YouTube description below. And that's a 9.5-hour course just on the deep dip buy, right? It's not order blocks and everything else, but it's a great place to get started. And that's very, very affordable. It's somewhere between $30 and $50. So anyway, that's my plug. But consider it. I'd love to have you as a student. I'll teach you everything that I know. Okay, so let's get on to next week. Amazon. All right. Now, I've been talking about Amazon for a couple weeks. Let me highlight the red bar up here. This is called a bearish abandoned baby. Why is it a bearish abandoned baby? Because we gap up and the very next day we gap down. Why is that important? Because when you get very quick changes in the sentiment of the market, think about the open. Oh man, everybody had to buy Amazon, had to buy it. Very next day, not so much. When these things happen, there's a lot going on under the hood. And when you have a very quick change in sentiment from bullish to bearish, very often when you look in the future, you're going to be lower. And was it right? It was. I was looking for a short at the bottom of this baby, the red line. It went down. I wasn't going to chase it there. I was looking for a move back up for a short. Look how close it got and down. So I didn't take the trade. I let it go. That's fine. But you can see sometimes the power of these bearish babies. It nailed it. It really nailed it. But at this point with Amazon, looky down here, what do we have? We have a bullish order block. And my favorite, we have a 200-day moving average. This is right there at the order block. So why is this an order block? Swing low, swing high, lower swing low, clearly market structure change. When we change market structure and we were way up here, if I look to the left, In hindsight, were the people that were buying in this order block, was it smart money? Yeah, clearly, obviously. So if we get back down now to this smart money area, is it going to be smart money area again? Maybe, maybe not. Things change, but more than likely, when you get back down to previous smart money areas, you get some kind of reaction there. Maybe, maybe not. Maybe we blow right through it, right? Things change. But I really like this setup. Now it's not there yet. This is where patience comes in. So if next week, if we may not even get there, but if we do reject the 200-day moving average that's right here at this order block, almost certainly I take that trade. We also have the orange line, that's the 300-day moving average inside the bullish order block. Would I, if we lose the 200 but reject the 300, would I take that? Most likely 100%, yeah, depending on what the risk reward does and other things. So again, I'm not really expecting Amazon to get here, but if it does, I'm going to be looking for rejection of the 200 that's at the top of the order block or the 300 that's inside the order block. That would be a high probability trade. Doesn't mean it has to work, but overall high probability trade, and I would certainly look for that. So that's what I'm looking on Amazon. Bitcoin. Had a lot of people ask me this week about Bitcoin. And so these are the futures. I don't trade these, but I just wanted to show you a couple things on Bitcoin. So, you've heard me talk about bullish order blocks, but there's also such thing as bearish order blocks. And this was a bearish order block right here. Opposite, swing high, swing low, higher swing high, market structure change. This defines the bearish area. Well, when it changed market structure to the downside, then it came back into the bearish area. Was it correct? Totally. Totally correct. And look what happened. Okay. So now at this point, we are getting quite oversold, but there's some interesting things here. Before I was talking to you about the 3-point megaphone trend line. Well, take a swing low, another swing low, connect those, that megaphone goes out into the future. If you get that third touch of the trend line, generally you'll get a reaction there. Bitcoin was not strong enough to do that on Friday. It closed below that point. It didn't have a rejection at that trend line. But what's interesting, we have another longer term trend line that Bitcoin bounced at the penny. Isn't that amazing? Let me show you. If we zoom out, we have a trend line back here, 10, 10, 24, swing low. We have a trend line back, a point here, 4, 8, 25. If you connect those dots and that trend line goes out into the future, look where we got to the penny, literally to the penny of that trend line. So there, from a trend line area on Bitcoin, there's some support here, and the market reacted exactly to that. So this could be a short-term bottom on Bitcoin. In addition, you have this other megaphone trend line here on the shorter time frame, where if we reject that trend line, then the low is probably in. So this is not a setup that I'm looking to take. It's just that I've had a lot of traders from around the world ask me my take on Bitcoin here. And this is my take. We are at, from these trend line perspectives, we are at an area where we very likely could bounce. So I'm just trying to, for the Bitcoin bulls out there, I just want to at least have some potential good news. We could lose this trend line and we could keep going down, but if I had to guess, I would think we would bounce here, but we'll see. FXY, Japanese yen. Okay, so this incorporates kind of a lot of things on this particular trade. Okay, I just talked about the 3-point megaphone trend line. Here's a swing low, here's a lower swing low. We bring that out into the future. It has not yet got to the third point on that trend line. It got very close here and did kind of bounce. But what we have here on FXY, in addition to getting close to that megaphone trend line area, we have a bullish abandon baby. I just showed you the bearish abandon baby on Amazon. Well, here's the opposite on FXY, Japanese yen. We gapped down. We gapped down. Things were very bearish. The sentiment was very bearish overnight from the close to the next open. However, the next day we gap up. Gap down, gap up. In general, that is a fairly bullish signal, okay? Now, in addition to that, if we look at the MACD here, we have a triple bottom MACD divergence. Remember, I studied with Dr. Alexander Elder one-on-one, and he taught me all about how to use the different double bottoms, triple bottoms, MACD divergences. But let me point this out. Look at this low here. This low here, we have very deep red MACD bars, okay, indicating very strong downward momentum. Then we rally, we go green, which is important. And then we come down here, we are lower here than we are here, but yet the depth of the MACD bars here, not as deep as over here. What does that mean? It just means from a MACD perspective, the move down here had less momentum than the first, which means essentially what the lack of momentum means, or the reduction in the momentum, is that you are running out of buyers. Well, then we had another rally, and now we are even lower here than we are here. But even though we are lower here than the previous low, we have no red MACD bars. This is called the double bottom with a missing right shoulder. If you're lower and you don't have any red bars, so this is really showing me that we are running out of selling momentum. We are in the low 30 RSIs, and of course we have this megaphone trend line here, and we had the abandoned baby, bullish abandoned baby. So I am looking for a rejection of, at this moment, of either a 30 RSI or a rejection of this trend line. And if it rejects the trend line, I would set up the trade, place my emergency stop. Simply my close, my end of bar stop would just simply be a close below the low of that trend line, giving me a good risk to reward ratio. But a lot of things going on here. Bullish babies, MACD divergences, megaphone trend lines, RSI divergences, ATR divergences, all sorts of stuff, okay? INDA, India, okay. This, I'm looking for a short. Why? Abandoned baby, bearish abandoned baby. We gap up. Oh my gosh, everything is the best. But yet the very next day we gap down. Uh-oh, very quick change in sentiment, indicating that we're probably going to go lower. And we did. But now we are coming back up to the bottom of that abandoned baby. That bottom of that abandoned baby is 55.11. If next week we rally, we reject the bottom of that abandoned baby, that would be a potential short for me. And when I trade abandoned babies, it's a little different than the rest. I place 2 ATR stop, 4 ATR profit target, 2-to-1 risk to reward ratio. And so that's what I'll do. So if we come up and we reject the bottom of that baby, I will consider getting short, 2 ATR stop, 4 ATR profit target. Because if we do reject the bottom of that baby, statistically, edge-wise, you're going to head down more than you're going to head up. But not for sure, but more times than not. And so that's why I'm considering taking that short trade. Southwest Airlines, LUV. Okay. Well, we have a bearish order block above. Why? Well, we have a swing high, we have a swing low, we have a lower swing high. I'm sorry, we have a swing high, we have a swing low, we have a higher swing high, and we change market structure to the downside. Okay, the highest up bar close before market structure change is now the bearish order block. Think of it this way. Was there smart money up here? When we were down here, was smart money buying up here? Clearly not. It was dumb money that was buying there, clearly. So if we get back up to the dumb money area, would that be a potential place to short? Yeah, 100%. So I am looking at this level here of 34.04. If next week we go above 34.04 and then close below 34.04, that's where I would consider taking a short. My end of bar stop would simply be another close back above 34.04. Now, if you remember, I was telling you about order blocks. I was telling you about halfway points in the order block. And let me go back here. Look, here's a V2, bar 1, bar 2, bar 3. 2 goes under bar 1's low, 3 closes above bar 1's close. Halfway at the bar 2 of the V2 is the support. That's the green line. It's also the order block. If we go into the future, I was looking for a rejection of this midway point in the order block. Look how I missed that trade. I missed that trade by about 2 cents. But you can see the thinking of where I thought it would stop was very accurate. But I never quite got there. Bummer, right? But it just goes to show you that these levels inside the order blocks are key, sometimes almost to the penny. And that's exactly what happened. So I missed that trade, which is fine. But now I'm switching teams over here to the potential short side with the rejection of the low of that order block 3404. And if it rejects it, I'll consider taking the trade. If it closes back above, I'll simply get out. MasterCard. Okay, well, MasterCard has been struggling. Here we go. Here's an order block below. I have drawn my own line in there, 532.90. Why? If we go back in the past, here's a V2. Bar 1, bar 2, bar 3. 2 goes below bar 1's low. 3 closes above bar 1's close. It's a V2. Take the half point. It's a V2, and I have this big up bar here. The halfway of the big up bar is the key level. I bring that into the future. There you go. 1, we have an order block. 2, we have a key level inside the order block of 532.90. If MasterCard comes down into that order block, rejects that level, that would be my potential entry. And in the future, if I take the trade and then it closes below the low of that, simply out. So I'm looking for a rejection of 532.90 on Master. Netflix. Okay, so recently we have a new bullish order block on Netflix. Why? Well, let's take a look. Here's a swing low. Here's a swing high. Here's a lower swing low. And then here we change market structure by taking out swing high. Okay, great. Swing low, swing high, lower swing low, market structure change. When market structure changes to the upside, I want to buy pullbacks because now market structure has changed. Remember, it's very simple. Buy dips in an uptrend, sell rips in a downtrend. Well, when you change market structure to the upside and then pull back, I'm buying a pullback in an uptrend now. And the uptrend happened because of the taking out this swing high. Now, look what we have. We have a major moving average, 250-day moving average, the purple line that lives inside the order block. That's the key. Identify the order block, look for key levels inside the order block. That 250, just by a rejection of the 250 just by itself, is a back-tested edge. But overlay the order block support into it as well, it improves that. So next week, I am looking for a rejection of the 250 and or a rejection of the bottom of the order block. That one's valid as well. So a rejection of the 250 or a rejection of the bottom of the order block. Now, Steve, one of my students, Steve, pointed out to me this week, oh, hey, we have a double bottom bullish divergence on Netflix. We do not, because for a double bottom bullish divergence, it's right in the name, double bottom bullish divergence. We need to make a double bottom. So if we come down and get equal to this bottom, yes, then we have a double bottom and we will have a divergence. Yeah, I can tell for sure that if we get there already that we'll have a MACD divergence because we have this big red, then we go green on the MACD. And so if we come down here, reject the bottom here, then we will have a double bottom MACD divergence, which would be great for sure, but we're not there yet. In order to have a double bottom bullish divergence, we have to first have a double bottom. So looking at the 250, rejection of the 250, or rejection of the bottom of the order block. I think both of those would be great. Nike. Okay, so Nike has recently changed structure to the upside. We have a swing low and a swing high in the same bar. Swing low, swing high, lower swing low. market structure change. And so we have this order block below us. So potentially I'll buy a dip into this order block. This order block's not too high, so potentially rejection of the high, the order block at 62.23, or rejection of the low, the order block at 60.38. And then we also have the megaphones here. Look, swing low, other swing low, connect those. When we made that third point on the trend line, it made it to the penny and bounced. Interesting, right? But in general here on Nike, I'm looking for potential rejection of the high at 62.18 or the rejection of the low at 60.29. Qs. The Qs so much, this is not so much for a potential trade as it was just a good learning point with trend lines. We have this order block here, okay? And if we connect this swing low and this swing low and we bring it out into the future, well, when we had the first sell-off here on the 6th, we closed below the trend line. So this trend line used to be support, and when we broke it, it was resistance above. And look what happened. We broke the trend line, but then yet when we came right back up, now the trend line's above us, there's resistance. As we came back up, I was telling one of my students this, I said very likely we're probably going to go down here because we got to the resistance level above. Exactly what happened. We came down. So this trend line is going to be resistance above you. Now, longer term, we can make this swing low, bring that out into the future. And that's probably where you're going to have support. Well, it's exactly where the market reacted on Friday. Isn't that interesting? So very likely on the Qs, we will stay above this trend line and below that trend line. Again, not a trade here. I'm just kind of show you sometimes the power of these trend lines. Shopify. Okay, nice signal here. We have a nice order block here, bullish order block here. I have a midpoint line or I have a line here at 136. This is my key level inside the order block. Why did we have that midpoint level? If we go all the way back here to the 2nd of September, look, again, big up bar. If I have a big up bar from a Fibonacci standpoint, halfway of that is going to be support. And these things have memories. So I have the big up bar halfway, bring it into the future. That future point, the 136, dovetails right in that order block. And I've showed you many examples, right, of almost to the penny. Doesn't mean it's going to stop at the penny, but very often that happens. So I'm looking for a rejection of 136 inside that bullish order block. The SPY, again, just to show you, we have the swing lows here. You connect the trend lines. We break to the downside. Now that level is going to be resistance. Didn't quite get there, came down, but what's really interesting, everybody, is the opposite end. We have the swing low. We have a higher swing low. We connect those together. If we come back down to that, we should get a reaction. Look at that. We reacted to the penny on Friday. Again, swing low, higher swing low, connect those out. If you get down there, very likely that's where you're going to get a bounce, and it bounced to the penny. TLT. All right. So TLT has really, really, really had a sell-off here. But it's getting to a very, very interesting spot here because we have a bullish order block, swing low, swing high, lower swing low, market structure change. As soon as we change the market structure, we define the order block, boom, we move it into the future. You can see once we broke above the swing high and we go into bullish market structure, we had a pullback where? Right to the order block, and then a huge move up. Now again, if we're looking at these prices up here, in hindsight, if you look back at the order block, was smart money buying here? Clearly, when you're up here and you look in the past, smart money was buying there. Well, the smart money area comes into the future. We are right smack dab in the middle of the smart money area. And in addition to that, we have interesting spots here. We have a big up bar here. Halfway of that is 88.73. I'm looking for a rejection of that. That's my first level to look for a rejection to get long. Alternatively, we have a 250-day moving average inside of this order block below it. That could also be a level where the market reacts at 88.56. And then below this, at the low of the order block, we have the 200-day moving average creeping in. So I'm looking for rejection of 88.73 to get long TLT, or a rejection of 88.56, which is the 250-day moving average, or it's just simply a rejection of the low of the order block at 88.46. But I like this particular trade, really do. TMC. All right, the metals company. Look, nice little setup here, everybody. We have a top of the order block. We have a 200-day moving average. So next week, earnings are past us. Next week, if we reject this 200-day moving average and or the top of the order block at 467, I would be looking for this. Now, so that's it. That's pretty simple. Rejection of the 200, or actually a rejection of the bottom of the order block as well, because the 250-day moving average is in the order block at the bottom, 397. So basically anywhere rejection of 470 down to 397 would be a sweet spot area for me to look to buy TMC. Let me take you back in the past. Here we have a rejection of the high of the order block. I was considering taking this trade here because it's legit, the rejected the high of the order block, but I decided I'll give it a little bit longer. Well, look at this trade. From that simple rejection of the top of the order block that I did not take here, that was at $4, and it went to over $11 in 2 months. Look at that. So again, I make the case. When you're up here at $11 with smart money buying here at 4, yeah, clearly. Well, we are back to that smart money area. And we have good levels to key off of. High of the order block, or the 200, or the low of the order block, 250. Walmart. Look, I don't know if it's going to get here. Very unlikely that it will, but I have a beautiful order block here. The high is 96.32. The low is 95.60. Bring this order block into the future. What's living inside the order block? 250-day moving average, right at the top. So the 250 is at 96.33. I would potentially take a rejection there. I think it'd be a good trade, but it's unlikely that it's going to get there. It may happen after earnings though. And last but not least, everyone, is XLF. Very simple. We have an order block here. We have a 200-day moving average inside. I would not take a rejection of the high of the order block because the order block's too tall, but I would take a rejection of the 200-day moving average, 51.35, and or a rejection of the low of the order block. And at the low of the order block, the 250 is right there as well, 51.01. So I know that was a lot of information. If you have made it this far, you are a hero. I appreciate you, but I hope you found this helpful, everyone. If you did, I'd appreciate if you could give me a thumbs up or a follow. It really helps with YouTube. If you're interested in studying with me with the 10-week course, I'll teach you everything I know. You'll be a better trader when you're done. I promise you. I've seen so many of my traders just thrive and do some really good things. But you have to learn, and I think the best way to learn is a little bit each week over different market conditions. So all you have to do is send me an email. We can get the conversation started. All right. So thank you so much, everyone. I hope you have a good rest of your weekend. Please be careful next week. I always leave off with, if you could please try to do one nice thing for another human being today or every day. It really would make the world a better place. If we all did one nice thing for everybody every day, it'd be a completely different place, wouldn't it? And if you have it in you, if you could try to maybe do one nice thing for an animal each day, they appreciate acts of kindness just like we do. So that's what I try to do. One nice thing for a human being, one nice thing for an animal. Maybe one day they'll return the favor to me, right? So look, if you have any questions about anything, please leave them in the comment section. I'll do my best to get back to you. But God willing, I will see you next week, everyone. And thanks again. Appreciate it. Take care and enjoy your weekend. Thanks so much. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.